Hey, hi. Today I want to talk about the 10 years US 10 years Treasury bond. As you can see, the bond yields have gone up quite significantly since August 2020, and now it's hitting 2.3. Um, the reason is because if the higher the bond yield is, right, there is a great there is a greater need by the US government to pay for the interest. Basically, in short, this actually means that investors demand for more um, higher interest rates from the issuer of the bond, which is the US government, before they will be attracted to buy this US 10-year bond. Of course, US bonds, they have the 2 years, they got the 10 years, they got the 30 years as well. But for this video, I'm just going to talk about the 10-year bond and the concerning fact that this is actually quite worrying if it continues to climb up. There is every reason for the investors, whether it is other countries' treasury funds, treasury department like Bank Negara or whatever, to demand for higher interest rates from the US government because, as you know now, money is losing value. Let's say you have $10 and you have an inflation rate yearly of 7 to 10%. That means you're losing, you by right, you're getting around 9 ringgit, $9 back worth next year. So in this high inflationary environment, there's this high possibility that these interest rates will go up, and that will result in more debts by the US government, which they need to service this interest. On the other side, I wanted to say is what happened if interest rates were to go up. Um, so the only way, like I mentioned earlier, is for these interest rates to go down, would be the federal government, I mean the Fed in US were to try to increase the interest rates, so that the value of the dollar is intact, won't be flushed away by the inflation. Mm, but it's like if you try to solve this by reducing your payment obligation, reduce the amount of money that you need to pay for the bond, by increasing interest rates also is a problem, because US is also a big borrower, and increasing interest rates will affect their um, balance sheet. Meaning, it's like, let's say I have 10 million loan, and the interest rates will go up 1%. It is 1 million that I need to pay. So let me show you a couple articles. This is interest rates affecting consumer, but because we are like looking at the macro trend on the um, how US economy will behave, or react, um, from this high inflationary environment. Um, so basically, let me show you one of the cards from. But the conclusion is basically this lah. It looks quite odd. These both methods are also would put the US government in a very difficult position. Basically, it's either their debt increasing, meaning they have to pay service the loan at not at 0% interest anymore, but higher interest rates. If they don't do that, then they are, because they are also borrowing in the bond market, they also need to pay higher interest rates, higher, we call it the bond yields, to the other institutional investors. So it's like a both way also problematic for the US government. Um, so a couple other things I'd like to just mention is relationship between interest rates and bond prices. Um, Anything that increases the demand for long-term treasury bond puts downward pressure on interest rates. Um, of course, in this case, we can see that the bond demand is actually low. That's why you can see the bond yield keep going up because now you are losing the second and the third biggest bond purchaser, which is US, I mean China and Russia, and then you need to rely on at least Japan or Korea or some rich countries to continue buying the bonds, which means actually lending to US government. So, but if you lose the second and third one, uh, it looks like the only way up for the US Treasury bond yield will be higher, and that will cause more money problem for the federal government because they need to use more US dollars to pay, and it looks like it might be problematic if they keep issuing money again. So I think it's going to be difficult, and this might cause the market to have another big big correction coming up. Thank you very much.